You're welcome to the Economy and Politics Show. I'm Ottoabasi Abasiekong. This edition will discuss repositioning the capital market to support Nigeria's $1 trillion economy size aspirations. Joining me virtually for this conversation is Mr. Johnson Chukwu, the Group Managing Director of Cowry Asset Management. It's nice to have you on the program, Mr. Johnson Chukwu.
Thank you for having me.
Thank you very much. Let's begin with the reality that the capital market structure in Nigeria still does not reflect the size of the economy. The equities market is still far from achieving the $1 trillion market capitalization. And we've had this conversation before. So I want to ask what must be done to deepen the capital market and key critical sectors of the economy. Recently, ProShare released its report on the capital market, and it showed that Nigeria's capital markets, stock market capitalization as a percentage of the GDP as at 2023 was 18% of the economy, compared to Kenya that's even above us 21% and South Africa that's 311%. And there are sectors that are still yet to reflect in the economy. What is your take on this, Mr. Johnson Chukwu?
Well, we have to recognize why the capital market share as a percentage of the GDP is not comparable to what you have in places like South Africa. Bear in mind that the Nigerian economy is still largely an informal economy. So there has not been a reasonable level of formalization. The South African economy is highly formalized. So you realize that several businesses in the country are not formalized enough as to get listed. Take for instance, the agricultural sector, which accounts for more than a quarter of the GDP, is largely informal, subsistence farming. You only have two companies that are quoted on the exchange. Look at the trade sector that accounts for about 15% of the GDP. No trading company is quoted on the exchange. Yes, the telecommunication sector that accounts for about 16% of the GDP, only two are quoted, MTN and Airtel are quoted on the exchange. The others are not quoted. The other ancillary services in the telecommunications are not quoted. If you now drill down the manufacturing sector, the construction industry, how many companies of the construction industry are quoted? So the only sector you have a reasonable percentage of quoting is the financial services sector, which basically the banks, because there's no PFA that is quoted today. The insurance companies that are quoted are quite weak in terms of market capitalization. So the key challenge we have to deal with is that we need to formalize the economy so that businesses have structure that will allow them to be quoted. Agricultural sector operators should become industrialized agriculture setup and they can be quoted. Go to South Africa. Look at the share price of this world. They are quoted. The games of this world are quoted. These are basically the trading business in South Africa. And that's why the capitalization of the Nigerian market, capital market, is not in any way comparable as a percentage of the GDP as that of a country like South Africa.
And of course, you know that, Mr. Johnson Chukwu, the South African Johannesburg Stock Exchange is a $1 trillion market. So, we have a long way to go, but there's something that has to be driven. We have a capital market master plan anchored by the Securities and Exchange Commission, which will expire by 2025. There are attempts around revising it. But how can it be repositioned to align with the country's broader economic realities and supporting the current administration's $1 trillion GDP size target? ProShare analyst observed in its report, latest report published on the capital market, that some of the economy's key growth areas are represented in the Nigeria exchange, like the ICT, like you said, financial services, construction, recreation, and services. But sectors like waste management, the arts and entertainment, where we're seeing so much activities of exports of our stars and celebrities, which are strong growth drivers, amongst others, are yet to be represented. How does the capital market master plan drive economy in a way, like you said, formalize the economy? What must be done, the linkages and formalization?
Well, I think we have to look at how do we get to interface with the business operators. I remember at some point in the past, the Nigerian Stock Exchange then, as it was then called, which is now NGS, was making efforts to bring in small, medium-scale enterprises to be quoted under the growth board. Growth board. And we went out to seek for companies we considered with strong prospects that are still basically family businesses to encourage them to get quoted. At some point, we also reached out to the football business operators, or what we call the clubs, football clubs. And we spoke to a number of the clubs to have them quoted. So we need to go back and look at that. The sectors of the economy, that there has to be some level of handholding, some mentoring that will help them to get formalized. And incentives have been created for companies to be formalized. Such incentives could come in form of fiscal incentives, like lower tax policy, discriminatory corporate tax policy that are in favor of companies that are quoted. So that way, the owners of this business will be incentivized to have the companies quoted, and given that other benefits of getting quoted. So it's only when we have the businesses properly structured that we can have them quoted. If they remain highly informal businesses, it's difficult to get them quoted. So the focus will be, how do we go to those sectors that account for a distinct percentage of the economy and encourage business operators in those sectors to be quoted? Today, we have a few Nigerian local retail outlets, like a banner. There's no reason why the business cannot get listed and have the access to the capital that's required to now expand and become a multinational. The Nigerian banks that have become multinational are partly because they got listed in 2007, 2008. And now they have access to funding, not just locally, but internationally. So I think the key thing is that there must be a concerted effort to encourage those lists. Like I said, we had the NGX under its previous name went out to seek for such formalization. Yes, granted, we didn't achieve much, but I don't think it's time to give up. I think it's something to go back to that process, and hopefully, with the high interest rate today, business operators will have a motivation to raise equity for their funding purposes and for their business expansion.
Very clear, Mr. Johnson Chukwu. As a market stakeholder, I know that you're emphasizing the need for those reforms, because formalizing the economy means that it has to be some reforms that unlock opportunities in the economy that will lead to key listings. And we hope government matches word with action as we watch the various steps and demands from private sector for liberation of key sectors in the economy. Let's look at something that has become a concern, of course, for the business community and its impact on the market. Foreign exchange volatility has led to major companies like the MTN and Nestle, Telco, and of course FMCG reporting losses. How is this impacting the equity market? The other companies have recorded losses too, whether it's shareholder funds, whether it's their revenue and all that. How is that impacting the market? And what are you seeing also as an insider?
Well, interestingly, the market performance seems to have been disconnected from even the performance of some of the companies. We've not seen a dumping of companies' shares where you see such huge losses, like Nestle recorded losses. MTN had to write down, absorb an exchange loss of about 40 billion. But interestingly, the impact of this have not been fully reflected on their stock prices. It looks like Nigerian market is now in an exuberant mode. Because if you take a proper analysis, I'm not talking about these two companies I mentioned, a proper analysis of some other companies that their performance top quarter of last year, and some of them have unaudited full year results. You see some of them are going to end up with negative equity, shareholders' funds. Some may end up with just negative profit, that's a loss. But if you look at their market for equity, the price of their equities, I don't think the market has really reacted to that. But in the long run, the market has to correct to reflect, one, current market realities, two, the prospects that the economy bold, and sectorial attributes or sectorial peculiarities. So the market has not done that. I believe by the time the companies will publish their full year audited financials and declare benefit, because the market is partly driven by benefits. And then I think we may see some level of corrections to reflect some of the issues we've discussed here.
Yeah, I mean, we're in the season of earnings and results. So like you rightly said, we'll track that. But of course, you've raised those fundamental issues again, which is very important. There needs to be a linkage, like you said, between the market and what the broader economic activities. But in recent months, we've seen share buybacks and there's a deficiency in free floats from major quoted companies. We attend meetings, fact behind listings and all that. We see stakeholders talk to group boards and chairmen that, look, we need to see more free floats on board. What is your take on this, and how does it affect the participation of retail investors in the capital market? Because that's also very important, especially in the equities market.
Ordinarily, elsewhere in the world, when you see a company buying back its shares, it's simply the company has so much cash, so much liquidity, and it just doesn't know what to do. It's always that is done by companies that are at the mature phase of their growth trajectory. So they don't see the investment opportunities, or they think returns on the investment will not be as high as the value that investors will get. But unfortunately, ours is slightly a different situation. You have companies that are buying back their shares because they can't deal with the post-listing requirements, or they don't see motivations to continue to be listed. And like you said, some companies were granted some waivers to list their shares even when they did not attain the minimum flow required for listing, on the understanding that they will come to the market and list additional shares to achieve their float. So in such instances where they are buying back the shares, then it then weakens further the float available in the market, and it becomes difficult for their market price to be reflective of the intrinsic value of the companies. Because when you have very low float on any equity, then you could see an abnormal pricing because the pricing is not reflected. You don't have a free market in that particular stock where you have many buyers and many sellers. So I think the key thing at this point is that NGS has to enforce the minimum float for all quoted companies. While you can cut some slack for companies that large value stocks, but there must be a time limit for them to list additional shares to achieve those floats. Without the float, the market will not be properly priced.
Very critical there. I like the fact that you said NGX is to enforce that minimum free float requirement from companies, and the post-listing requirements. Again, it would be also nice to know from the stakeholders, the listed companies, what are those issues, but very important. The retail investors need to be involved. We need more clarity and understanding on what is happening. Mr. Johnson Chukwu, looking ahead, 2024, what do you see as the drivers and, of course, the risk for the market this year, looking at broader macroeconomic and, of course, the risk?
I think we have to look at the monetary policy of the central bank. That will determine what will happen in the economy. We've seen the central bank has sucked out more than 7 trillion from the economy in the past 6 weeks or 8 weeks. Then we're seeing the banks depending on the central bank's standing deposit facility to sustain their liquidity. So you're going to see liquidity, this trajectory continue, you're going to see liquidity dry out of the system. We saw the central bank issue the 364-day T-bills 2 weeks ago at 20.49%. And we're going to see liquidity flow into the central bank, and that would affect the available liquidity for investment in equities. It will affect the available liquidity for business operations, for this sector businesses. And ultimately, you're going to see a slowdown in productive activities, a slowdown in economic activities, a slowdown in employment, or increase in the level of unemployment. So I think a lot we have to be on the lookout for is the policies of the central bank as it relates to monetary tools, particularly the speed at which they are tightening liquidity in the economy.
And just in 1 minute, Mr. Johnson Chukwu, are you optimistic that we'll see more key listings in the equities market this year based on the current realities?
I did say earlier that at periods of high interest rates, because what you look at, what is the weighted average cost of funds? And we are moving to a period where the cost of equity will be cheaper than the cost of debt. Ideally, the cost of equity is always higher than the cost of debt. But if we are dealing with such high interest rate environment, it will be an incentive for companies to look for alternative funding source, and that would be defaulting to equities. So if that be the case, we may see companies do public offers or private placements, and with that the ultimate objective is to create liquidity in their stock, and it will certainly lead to some listing.
That's something that we'll also track to see how this high interest rate continues to shape, and hopefully spur companies to explore equities and come to the market to list, to deepen the market, which is very important. We need to move from 18% of the GDP to a higher level, and of course support the $1 trillion GDP aspiration, and also achieve a capital market capitalization of $1 trillion. Is still something that can be achieved. Thank you once again, Mr. Johnson Chukwu, for this opportunity. Group Managing Director, Cowry Asset Management. Thank you for always availing yourself when we call on you to discuss the capital market, which is a very key catalyst of the economy. Thank you once again.
Thank you for having me.
Thank you. To our viewers, if you want to get further insights on this conversation, visit the ProShare website displayed on the screen and follow our social media platforms to engage further on this show. Till we come your way again, enrich yourself with the knowledge of socio-economic developments around you, because it is a wise thing to do. I'm Ottoabasi Abasiekong. Thank you for watching, and bye for now.